Good afternoon, ladies and gentlemen. Welcome to another session to get more information about Silver Star Properties REIT. I'm happy to have with us here today co-CEO Dave Wheeler, President, and we're going to team up, David.
Yep, this is great, Gerald.
And we're going to divide what you're going to do, what I'm going to do, and then take care of everything. And you're going to get most of it.
I'm looking forward to this.
And you're going to do good.
Yep.
And so I'm welcoming David. I'm going to tell a little more about him because I have seen him mature, and I don't mean that from a childhood kid to an adult, but really become a chief executive officer in a very, very short period of time. And so he's got a tremendous career here at Silver Star, and the future looks good.
Thank you, Gerald.
And he will be leading our charge in the self-storage space. So we're going to do two things today. We're going to let David pick up where we left off last session, and he's going to talk about what I said at that time, which is, where are we headed? That's self-storage. He's going to dig into that in much more detail, and that'll be helpful to all of you as we decide how we're going to go forward. Now, the matter we have to get over first is completing the resolution of the problems that Al Hartman have developed. Those are well along the way. We have successfully got a stipulated judgment where he has admitted he has no interest in our real estate assets. That allows us to continue with the sale of property that he had thwarted by improper filings. So we're looking forward to being able to continue. And I must say at the outset, we're really in good times right now. I just looked at the market today, and I got to say, as a director of almost 20 years at Meritage Homes, and as a leader in the pivot into first-time home buyer, Meritage is up 100% over the last year. There's a connection. David's going to talk about that in more detail between first-time home buyers, affordability properties, and self-storage. And I think we've got similar opportunities right here in front of us with respect to the self-storage industry as we saw in building Meritage Homes. So let me start out, David. Tell us a little about your background, more details, and what brings you to the self-storage industry. But let me assure you, there's one person here that's really excited you're our self-storage person.
Well, thank you, Gerald. It's great to be here with you. It's great to have an opportunity to visit with our investors. My experience with self-storage began over 30 years ago when I was at CBRE. During that 16-year tenure at CBRE as a vice president in the investment services division, I completed the sale of over 9 million square feet, including 13 self-storage facilities. While there at CBRE, I represented Storage Trust, which is now part of Public Storage, the largest publicly traded entity in the self-storage business, during its Dallas-Fort Worth expansion.
So when I think about self-storage, you know what I think of. I think of the first-time home buyer buying Meritage Homes. Now, what is it that made it an attractive asset for you?
Yeah. So it's a lot about changes in the economy and changes in customers' lives and how that's changed demand over time. Self-storage can be steadily successful throughout the economic cycle, so we like its stability even during mild recessions. The structure for the leasing provides an opportunity for strong growth merely by following industry standard customer rent raises every 6 to 9 months. Self-storage provides more opportunities for growth in this regard more than any other real estate sector. This also allows institutional operators like Silver Star to grow revenues and NOI faster than the rate of inflation. Net operating income margins range between 60 and 70% depending on the rent levels in the local market. And cash flows are steady throughout the cycle because lease turnover and tenant turnover is relatively costless. There are over 50,000 storage facilities in the U.S., and only a third are held by institutional investors. So there's significant room for aggregation of the assets held by smaller operators, even in strong secondary markets. There are tens of thousands of potential acquisition targets.
So with that introduction, self-storage is certainly a major leader in the overall real estate sector. I think of the overall real estate sector as including lots of different properties, but self-storage is a leader. But what about this current environment? You know, we've got the opportunity in the real estate sector generally, but also address, as you do that, the macro influences and the high interest rate environment. How will it perform in that environment?
Yep. So historically, storage has been one of the best performing asset classes over the last 3 to 5 years, but storage typically outperforms other real estate classes in a recessionary environment. That's a key thing to keep in mind. Demand from existing customers is steady throughout the cycle with respect to price. Customers don't want to move their stuff, and there's typically not enough savings from nearby competitors to justify such a move. Further, self-storage benefits from additional demand in a dynamic environment. On the down cycle, they're downsizing and moves due to job losses, which means more storage need. On the up cycle, there are household formation, income growth, job growth, and an uptick in housing transactions, a lot of which means more storage means. Among the real estate sectors, storage commands the greatest flexibility to raise rates on existing customers. So the one thing to keep in mind is, as a favored asset class, we can often obtain favorable interest rates, and demand for debt capital as well as equity capital is stronger in that submarket than it has been in many of the other submarkets. So once a customer moves into the space, they're highly unlikely to move out until there's a change in the need for storage. In other words, they don't move out because of rental increase. The $10 or $20 additional rent that is so meaningful for our bottom line across the tenant base is not important enough for the customer to cause them to move their storage. The industry standard is to raise rent for customers about every 6 months after they move in and every 9 months thereafter. The rent increases are typically 7 to 15% each time. The only sector with more flexible rents is lodging, but let's remember how elastic and pro-cyclical the demand is in a typical hospitality property. You don't have that in self-storage. It's much more stable from an economic standpoint.
Yeah, hospitality is about the most volatile there is.
Very volatile,
Right.
very volatile, yep. And
So,
so
in
the
the
customers stay for years in self-storage. You don't get that in
Right.
hospitality.
So in the long run, how does it compare to Class A commercial office?
In the long run, it compares very favorably for a number of reasons. One is the sticky customer base. Two is the relatively high occupancy maintenance. But most importantly, or perhaps most importantly, is the low capital needs on an ongoing basis. So you don't have tenant retenanting costs as tenants move out and new tenants move in. It's relatively costless for that ebb and flow while you maintain a relatively high
Right.
occupancy.
So if you look at it in that vein, then if you're buying an asset high, and I don't mean high absolute, but relatively, does it bring more risk or less risk? How do you grow it? How do you grow the NOI?
Yeah, the best way to grow the NOI, there's a dynamic pricing in the industry. It's much like the airline industry, where you can use algorithms, you can use market research to make sure that the tenants are paying at or above market rents on a regular basis. So you can use those dynamic pricing models to drive revenues, to drive NOI increases, and they don't affect your expenses at the same time. So
Okay.
it's a great way to keep NOI strong and increasing over time, even while your facility's occupied. You're not necessarily relying on occupancy increases, you're just relying on rental rate and NOI increases from those rental rates.
And I'm going to ask you a few questions about rental rates
Sure.
later.
Yep,
But in this business, it's about the rental rates.
it's about the rental
In
rates.
commercial office, we had to deal with the TI more,
Yep, it's
There's
about
no
occupancy and
cost
controlling
generally.
capital costs, right.
right?
Right.
I think self-storage may have an advantage.
It has a big advantage in that regard.
Yeah.
Yep.
Okay, so explain this to me. You know, 2/3 of the market are mom and pops, as you said. Now, how are you going to consolidate those?
Well, there's roughly 50,000 facilities nationwide with an average size of roughly 60,000 square feet. So if you do some quick math, you get to 3 billion square feet of storage spread across a population of 330 million folks. So that's roughly 8 or 9 per capita, square foot per capita nationwide. 2/3 of those facilities are owned by mom and pop or local operators who typically own 1 or 2 properties and are often not sophisticated managers. This type of fragmentation creates a great opportunity for institutional owners and operators to roll up or aggregate within the industry. This has been ongoing for 20 years plus, but the sector has grown appreciably over that time, so there's still plenty of green fields ahead. Lots of developers out there building facilities that can be acquired by smart, aggressive, and well-capitalized owners. Silver Star will be able to do that.
What about, is it the institutional asset or is it the institutional mindset of the buyer?
Well, it's a little both, but most importantly, it's the institutional mindset of the buyer.
So we can compete with the big guys.
We can compete with the big guys. It's all about making sure your strategy is on target and your execution follows your strategy.
Do you think we have a competitive advantage?
I'm confident we do.
Okay.
We're nimble, we can move quickly, and we can go places sometimes where they don't have the time and the opportunity to go.
Or the desire?
Right,
Right.
right.
It doesn't move the needle enough for them.
That's true. That's true.
I like to move the needle.
That's true. If
For
you're
us, we're gonna get the needle moved for something a little smaller.
correct.
Could be several mom and pops.
Yeah, that's correct.
We're in sync there.
We are.
I like that. What is it about the customers that makes the storage assets attractive to first-time home buyers?
So about 80 to 85% of our customers are residential, and the remaining 50 to 20% are primarily businesses. There's quite a bit of ambiguity about these proportions. It kind of depends on the location of the facility, because there's also so many small businesses that actually sign a lease under the individual name of the owner. Business customers tend to rent larger spaces and are more likely to rent multiple units and stay for a long time. Some of them actually sort of operate out of that space. Demand from residential customers tends to be more inelastic than the business customer demand, because business customers are often paying close attention to their bottom line, and they have to. Due to these nuances, a sophisticated owner-operator will often differentiate rent increase processes between residential and the business customers, and be a little more lenient with the business customers on rent increases. Intuitively, we expect that apartment residents are more likely to need storage because of their physical space is more limited than a homeowner space, but surprisingly, 55% of residential storage customers are homeowners, and only 42% are apartment renters. So, interesting that the single-family community is providing.
They're there.
They're providing the majority of customer base.
That's why we're gonna track this
Yeah.
single-family first-time buyers.
Yeah, and the explanation for that counterintuitive result is that homeowners tend to be further along in their careers and earning power, so they have more stuff to store and they have more disposable income to afford those rents. So, homeowners who often rent storage have 2-car garages, attics, and basements, and yet they still have a need to store additional items. So, storage demand comes from so many different types of customer needs and life events, and it's one of the features that makes it so resilient throughout the economic cycle.
So are these millennials moving out of apartments or retirees moving into first-time homes, or what are the demographics?
Yeah, I think you've got a little bit of both, but primarily it's the younger folks that are doing
So
it.
the Gen X.
Yeah, Gen X and below. So
You're surprised I knew about Gen X.
Yeah. I think it's the Gen X and the millennials who are either kind of forming their first household, or perhaps upsizing a little bit, but they still, maybe they've inherited some furniture and they don't have room for all of it. So there's lots of folks like that find the need to provide,
So I got
require
another
storage.
subject here I want to move into, but I have to ask you one question
Sure.
about what you just talked about. How do I know whether somebody is a business user or a resident or adult child of a resident or whatever?
Yeah.
How do I keep track of it? Is that easy to do?
It
Because
can't-
you're differentiating perhaps the rental increases.
Yeah, it can be easy if they're renting under the name of the business, but if they're renting under an individual's name, it may be a little bit more challenging. But also what you'll notice from time to time is they tend to be, the business users tend to be a little bit more focused on the drive-up facilities, the single-story drive-up facilities, where they can quickly access the materials in and out of their truck or their service vehicle. If you're talking about if you're talking about a multi-story urban facility that is not as easily you can't back up to the door, they may not be able to get to their materials as quickly, so they may be less inclined to use those facilities. Those may be more residential renters and less business
Okay.
users.
I think it's opportune now to go to technology.
Right. Right.
With the right mindset, how do we make money with the new technology?
Well, technology's changed the industry to make it easier to enter the market now. So there's a broad range of elements in self-storage that have been enhanced by technology. We can manage remotely by placing wireless cameras all over the property at modest cost and have these video feeds monitored by computers and supervised by humans when a problem or security threat comes up. We also have automated gates to restrict access and ensure that only paying customers are allowed onto the property. It's amazing how fast a delinquent customer will pay their overdue rent when they show up on a property and they can't get through the gate because their code's been deactivated automatically due to non-rent payment. Our customers, here's a more important point, our customers use search engines and aggregators to find self-storage.
That's not political aggregator.
No, not at all. And that's close to their home of business, so they can price shop online and rent online for many of their storage needs. So they can check out reviews from other customers, and ultimately they can rent online with a credit card and a driver's license. So that's an exciting part of the technology that's changed the business in recent years, is the phone apps and the ability to search for a facility and rent a facility from your phone.
Okay, I just have a feel, if you don't mind, Dave, for a commercial break.
Sure.
The commercial break is two purposes today. You tell about self-storage, and I'm going to tell about why Gerald Haddock, Jack Tompkins, and Jim Steele, as your incumbent directors, need to be elected in order to carry out this business plan that this man is espousing. And we're going to be behind it, and I believe the opposition is going to be 100% against it. You didn't make somebody mad, did you?
Not that I know of.
But we're all for it, and this is how we build a growth company and build it much beyond what it is today. So as soon as you get an opportunity, the proxy card solicitations are in process, and go to the call number and the portal, and you'll have the card, and vote yes for these three directors. I appreciate that. Now, David, I'm going to ask you another question.
Sure.
Unless you want to add some more about.
Yeah. Let me
got a
talk
few
just a
things to
little
add.
bit more about technology, Gerald. There's sophisticated data software, including data mining, machine learning, and artificial intelligence, eventually, that'll drive pricing algorithms. And we've talked a little bit about this already, but that's part of the exciting part of the business about driving revenues, about increasing NOI while you're controlling expenses. Is this dynamic pricing that goes on within the industry. This has been a boon for owners and operators and not so great for customers so far, especially those that are sophisticated enough to employ it and have access to it. This is also a helpful service for us as owners and operators by transforming storage unit auctions from the traditional on-site auction-led process to an eBay type of model. Operators can run auctions at any time, and it's warranted and to create greater demand from online buyers. Used to be that when you did them on site, you'd get 5 or 6 bidders. Now you can get 20, 30, 40 So it's become a much more competitive process, much more efficient process with the online auctions. So that's kind of all I had to say about technology at this point, yeah.
Well, what about remote management?
Yeah, remote management, it's an exciting part of the business. It'll allow a medium-sized player in this part of the business to really accelerate growth where applicable. There'll be some places where it works well.
Is that how you catch up with the large guys?
It's how you catch up with the large guys, and it's how you operate facilities that are conducive to operating that way. So occasionally you'll have a facility where you need on-site presence, but we'll use it where we can. Yeah, very efficient.
So, but practically, how does it work? Are we talking about the cameras, algorithms, Face IDs? What's the practical side of it?
Well, you'll still have a property manager on any given property.
So we will not have at the outset proper management, a property without a person being there,
Well,
or it'll be phased in or phased out.
yeah, so some of these remote facilities will have one person managing multiple facilities and visiting those multiple facilities on a regular basis. Some of the more urban and dynamic facilities will have an on-site presence pretty continuously. So it will vary from location to location. We'll have to parse through that on a property by property
So what are your
basis.
favorite markets?
My favorite markets are the South Central, the Southeast.
Texas?
Yeah, it's definitely Texas. We have a great presence here already in our legacy portfolio. As we roll out of the legacy portfolio, we love the cities that we're in, DFW, Houston, San Antonio. But we also like Austin and other Texas markets. We love the rest of the South Central, and we really enjoy and appreciate the Southeast.
Florida.
We're also Florida for sure,
Carolina.
Georgia, South Carolina, definitely. The southeastern states, SEC.
Yeah, they're good.
And, yeah, they're great, and
Now,
we're.
why'd you have to mention the SEC? Yeah, we got a lot of
We like the big-
stockholders.
we like
got a
much
lot
of
of
the Big
stockholders in the SEC. So we reach out to both of them, everybody.
Yeah. We also like the Mountain West and the Mid-Atlantic as well. But we'll focus most of our efforts in the near term on South Central and Southeast. Yeah.
I like where the energy business is,
Yep.
Southwest,
Yeah.
Texas.
Job growth, employment growth, population growth. They're key
That's
drivers,
all
and
there.
you want to look in locations where those are happening. So.
So, tell me about the acquisition team.
Yeah, so we've
You
sourced.
feel good about it?
I feel good about it.
Are they qualified in self-storage?
They're qualified in
You've
self-storage.
worked with them for a while?
We worked with them for a while. We sourced over $3.5 billion of self-storage assets since December of last year. Hundreds of self-storage opportunities. We're established with the
So is the
self-storage.
pipeline good with what
The
you
pipeline's-
would like to buy?
The pipeline's very good. We're very pleased with the development of the pipeline, and we think as we move into next year, there'll be even greater opportunity. We think we'll have a lot of sellers return to the fold that have been on the sidelines over
Right.
the last 6 to 12 months. With the capital markets disruption. So I think it's a great time to be coming
I
back into the
tell you
market.
what, the
Yeah.
Fed breathed today,
Right.
or sneezed, depending on how you look at it, and the market just boom, took off.
It's been interesting. It's been very
Yeah,
interesting to
so,
watch.
I mean, it's unbelievable
Yeah.
right now.
Yeah.
Interest rate, 10-year treasuries, 5-year treasuries coming down, values going up.
Yeah.
How quickly can we get out there?
We can get out there pretty
We probably need a
quickly.
position right now.
Yeah, we do, and I can't make an announcement yet, but I can tell you, Gerald, we're actively working on an acquisition at this point, and we should be able to make an announcement soon. So
Okay.
that
Before the end of the year?
hopefully before the end of the year. Yeah,
Is there a 1031 transaction?
you're on the right.
Possibly?
Yeah, it could possibly be, Gerald.
Okay,
I cannot confirm or deny, but I think you're on the right track. You're getting one.
I like that. And we save taxes,
We do save
and it gives
taxes
us more money to invest in self-storage,
to
right?
invest. Yes, that's correct.
Oh, yeah, that's fantastic.
Yeah.
So out of these build-out markets that we were talking about, and I say build-out, the one we're gonna target, no question, we're gonna hit Texas first. Right? And I'm guessing that's where
First
your
and hard.
property is.
Yes.
And so, anything else you want to cover on the team, or
No, I think,
So how are you gonna manage it once you get it in the door?
yeah, so we're gonna use third-party managers as we aggregate a portfolio. There's some really qualified ones out there that are very good at managing the business, very good at pricing the business, very good at timing the raising of rental rates, very good at controlling expenses, and tremendous at marketing. So, it's just the best solution for us as we aggregate a portfolio to use those third-party managers. Downstream, a few years down the road, as we've aggregated a portfolio, when we get to a certain
Yeah.
size, we'll probably look closely at the likelihood and the reality of bringing, that management back in-house.
How large do you have to be then?
Yeah, you're probably gonna have to be 75 to 100 facilities before we start to seriously consider bringing that inside and have,
Will there be people
efficiencies and
available to do it?
scales. There'll definitely be people available to do it. We just have to assess at the time whether that's the right path moving forward. You can be successful using third-party managers. It's proven and.
So is there
and
a
there's some good ones
premium
out
in
there.
the market for not having third-party managers? Or does it not matter in self-storage?
Yeah, I think definitely at our scale, it doesn't matter.
Okay,
In fact, it may be much to our benefit to be able to use them.
yeah, it's cheaper.
It's cheaper, and it's effective.
Yeah, okay,
So-
good. But you got flexibility,
Right,
and those are issues as it builds, you can wrap your arms around all of it.
right.
So, we dealt with this a lot in commercial office, and shied away from development, except in unusual situations like bolt-ons or some of the residential we were involved with. How do you feel about development as it relates to the self-storage?
Yeah, so we're gonna stay away from development. I don't have any expectation that we'll have investments that have long lag times before they produce cash flows. We're looking for reliable cash flow that we can grow through proper management. It's worth noting that an occasional expansion project may be attractive, so it's reasonably possible that over time, we're gonna acquire some facilities that have a second phase or a third phase that has not yet been built on, and we'll be able to add to those. But kind of ground-up development with no existing facility there is not something we anticipate doing anytime soon and possibly for the foreseeable future. So,
So if you look at the big picture, we're going to come out of this solution with Mr. Hartman with a lot of cash to deploy with financing into the self-storage business. When I look at real estate as an investor, there are always timing ramifications. Is it a good time? Is it a bad time? Because historically, it is cyclical by
Yep.
nature.
right.
Because of the capital-intensive nature of it generally. But self-storage, as you mentioned earlier, seems to be a little more resistant on the downside.
Yeah.
And it still has the robust opportunity on the upside.
Yeah,
So the $64 question, is this a good time?
it is a good time. You and I have lived through a lot of cycles,
Yes.
and some of them pretty,
Listen, I was in home building in 2008
right,
and
right,
fought hard
Yeah.
to get to the other side.
right. And that was a
And we're
big
not
challenge.
anywhere close to living something like that.
Yeah,
again.
that was a great challenge for the great financial
Yeah.
crisis. But, so the softness in the commercial real estate market, especially in the self-storage space, is not anything like what was experienced in the great financial crisis. Right now, it's mostly, interest rate driven, it's mostly capital markets driven, and most of that's just driven by the debt costs. So as debt costs come down, we think it'll be even more attractive, as we move forward. Cap rates they're gonna look good as interest rates come down, and we're able to provide some cash flow, above, debt service that's just tremendous for the properties and tremendous for the company. So it is a very attractive time. The market's been a little soft from a disposition standpoint for about a year and a half, and we think there's gonna be some pent-up demand to sell properties. Some developers are gonna need to get out, and there's gonna be capital availability that will help facilitate that.
So, David, with respect to whether this is a good time or not, I think it would be helpful to just tell us a little about the history, 2021,
Yep.
22, as it compared to 23.
Gerald, 2021 and 2022 they were record performance in the self-storage sector. So anything past that feels a little soft, but the market's kind of normalizing, and it's actually a robust in an absolute sense, and relative to other real estate sectors, storage continues to be really successful. So given this backdrop, the publicly traded REITs are very slow to acquire right now the types of properties that we are targeting because they feel like their shares aren't trading as high as they'd like due to their cost of equity because it's perceived as being high. As for the large private players who'd normally be snapping up and aggregating quality deals to scale their assets under management, their cost of debt is too high and they do rely on that financial leverage to hit their targeted hurdles. So it's a little bit quieter in the space momentarily from an acquisition standpoint, which provides a strategic opportunity for somebody like us to come in and start to become an active player before they scale back up quickly. So this really leaves the field open for a market entry for a player like Silver Star. And to be a strong competitor for quality deals, both the single asset deals in that $5, $15, $20 million range, as well as the portfolios in the $25, $50 million range and up.
So does that mean you like where you are?
I like where we are a lot.
You like the cash?
I like the cash flow, and I like the capital opportunities moving forward, the ability to raise capital in the space, and the ability to aggregate a sizable portfolio.
So we want to move forward pretty quickly.
We want to move pretty quickly.
So tell me about that story.
How
do we get there?
How do we get there?
What's your vision of the future?
Yeah, as we trade out of those legacy assets, we'll continue to produce capital opportunities for growth. It's our expectation that we'll become publicly traded as soon as possible, and we'll be able to aggregate within 3 to 5 years a sizable portfolio that would scale us in the kind of small to mid-cap space publicly. So we're excited about that opportunity. We think we can quickly and efficiently and favorably aggregate a nice portfolio of self-storage
Yeah,
properties.
that's great.
Yeah.
So one of the things I've really enjoyed about our conversation is that we have to balance the mom and pops with building institutional assets.
Yep.
And so if we maintain that institutional mindset, it almost in many instances doesn't matter what we buy because it's what we're going to convert it into.
Right.
Is that true or not?
There's some truth to that. So the key is not only acquiring institutional quality assets, but operating them as an institutional operator.
Correct.
And making sure that they are harvested like an institutional operator will know how to make
We
them
want to make
perform.
sure the public markets accept them.
Right.
And you're well on top of that.
Yep.
And I appreciate that. So how much you think you can put to work in 3 to 5 years?
Yeah. So we think in the near term, we can probably do a couple $100 million in acquisitions per year, and we'll be able to scale that to a billion-plus portfolio in 3 to 5 years and keep ramping up that ability to scale beyond that. So, 100, 2 million, 100 million, 2 million should be pretty achievable pretty quickly per year on a forward basis, and I think we'll be able to move the needle above that probably in the 2 to 3 year time frame.
That sounds like a value proposition.
It is a value proposition, and we think we can scale a favorable portfolio into the public markets,
Right.
in a relatively short time frame.
Is there an asset class
Yeah.
in real estate that you would pick over self-storage?
Well, there's some others that can give it a run for its money. I think you know about the industrial space being very favorable.
I like the industrial space.
Yeah, the
But
industrial
it doesn't mean we can't buy some industrial.
Yeah, I think we'll consider some opportunistic plays if they are strong performers for the shareholders and give us some real value creation opportunities and some real cash flow opportunities. We'll consider those, yeah.
So what about distributions? I'm not gonna ask you for the board's attitude,
Yeah,
but personally,
yeah,
what do you think the shareholders want
yeah, so,
and your vision?
yeah,
As it relates to building a portfolio?
yeah. I
Because you
think-
could take different approaches.
Yeah.
You could go develop, you could do things that require capital
Right.
rather than create capital. So talk to us about that.
Yeah. So, as a real estate investment trust, we're obligated to pay out a certain amount of our cash flow to meet, REIT requirements. And our shareholders expect, a nice distribution and a nice dividend. But the key to keep in mind is that's based on taxable income. There may be some cash flow over and above that we can use to redeploy back into the business. But we definitely want to drive those shareholder returns and drive those distributions. We want to become a dividend aristocrat. So we want to establish a reasonable base dividend that we can grow upon reliably over time as we scale the portfolio, as we scale asset performance. So I think that's going to be the key.
So we acquired a company called Southern Star. With all the plans we've talked about, has that been helpful? And how does it fit with these plans going forward?
Yeah, so as you know, that Southern Star platform is all self-storage. It's 9 assets that have been acquired so far in Delaware Statutory Trust.
Explain Delaware Statutory Trust.
Yeah, so Delaware Statutory Trust is essentially successor to tenant common. It's a 1031 opportunity for a lot of investors to get into a property where they've got a capital gain from a prior sale of real estate that they don't want to recognize. They'd rather put it back into real estate. And so Delaware Statutory Trust is an opportunity for them to do that and have us manage the asset for them on their behalf. So it kind of takes them out of the owner-operator business and also gives them a chance to defer taxes. So it's a very favorable transaction for a lot of sellers. It gives them a good distribution moving forward, and for a lot of folks, it's an estate planning opportunity. Yeah.
So are we going to operate that separately, or what kind of integrated management are we
I think it'll be
with?
relatively integrated. I think there's not going to be as much overlap as people might think in terms of acquisition opportunities. I think Silver Star is going to, at the parent, we're going to be focusing the real estate investment trust on primary and secondary markets where we can acquire and make those institutional quality assets perform. Southern Star is going to be a little bit more focused on secondary and tertiary opportunities where they can acquire from mom and pops and maybe push rents, but they may not be quite as high quality opportunities, but they may have really good, strong, favorable cash flow characteristics. So
it has been helpful.
Has been helpful. There's expertise there, and we're moving forward. Yep.
And when will Silver Star be available for trading on a national exchange?
Yeah, so
And what are the plans there?
Yeah, so in terms of becoming a publicly traded entity, I think the plan there is to become publicly traded as reasonably fast as possible. I know that this management team, this board understands that that's a key priority for the firm and something we're already talking to investment bankers about in terms of the timing, and we're positioning the firm to do that. A number of aspects already position us favorably in terms of our public reporting capabilities and the management team. So we're excited about the opportunity to get publicly traded here within probably a year or two. Yeah.
And we're starting to talk about distributions.
Right.
Of course, that's a factor.
Yep.
And I wanted to ask you about both of those at the same time.
Right.
When are the stockholders going to start getting their money back? Or is the liquidity through an established national exchange part of that plan?
So we working towards that liquidity is definitely a part of the plan, and it's something we want to accomplish as fast as possible. But also driving those distributions and driving those dividend income to those shareholders is a key priority. We want to make sure that happens as fast as possible, and we're looking with an opportunistic eye
Well, as long as we don't have a big debt that's about to mature.
Right.
Which we're not going to have anymore.
Right. With our refinance, impending refinance, early part of next year, that should take care of things for a while, and it should position us favorably to start looking at reestablishing the dividends, perhaps in the second half of next year.
So if we get the pivot completed, we're in self-storage. Generally, what type of returns will self-storage industry-wide throw off?
So shareholder returns on an equity basis, we think they're going to be in the double digits. Combination of stock price appreciation plus dividend income is going to put us somewhere we can provide equity returns into the double digits. So, and we're expecting kind of mid-single digits on a dividend yield, once we're reestablish the distribution. So we're excited about that, and we think those opportunities are there.
So David, thank you for the excellent input with respect to where we're headed with self-storage. I want to bring this to a temporary conclusion because we intend to have these so-called fireside chats. I like calling them that, but we may switch from time to time to a more formal town hall so we can be a little more academic. This has been fun.
Right.
Hopefully it's been enjoyable to each of you, and we want to do this on a regular basis. And we'll be coming back to you next couple of weeks. I know we got holidays, but we got a lot of important things going on. The main thing that's going on, we got, unfortunately, a proxy battle. And I want to make sure that everyone remembers that we're here to talk about the problems that have been created that have slowed down our ability to go into the business that David has been talking about. And it's cost money, but we have some things working to recover some of that.
Right.
We're in the process of filing a big damage claim against Mr. Hartman, and Winston and Strawn's taking the lead in that, and we expect good things out of that. So stay tuned, and we'll give more information later with respect to what's happening in that arena, so to speak. I say arena because that's really what it is.
Yep.
So remember, we've got the votes. Gerald Haddock, Jack Tompkins, Jim Steele. Go to your quickest proxy access and vote in the portal. And we appreciate your consideration. And what you know is that we're going to continue moving in the direction that Mr. Wheeler has just talked about.
Yeah.
And I think has done a good job with it. So, look, thank you for joining us, and we will see you soon. Happy holidays, Merry Christmas, and hopefully we'll be talking to you before the end of the year. That's our goal, but, you know, if we get too much turkey, then it may not be that we'll be able to meet it. But we're working so hard, we're going to do it anyway.
That's right. Thank you, Gerald.
All right, David.
And thank you, shareholders.
Thank all of you.